This is a fairly old article about the gold price conspiracy. I know it's from November 4th, 2011, but it's really quoting April 28th, 2009. As a reason I'm kind of looking at this, because I just want to look at the overall again, because I don't think anybody can tell what's going on with the price of the metals in a very short time, if they know, unless they know what the news is going to be before they put something out on the news wire. Or they also know what Bren Bernanke might do. Quantitative easing would obviously make the metals go much higher a lot quicker. But I just want to review this stuff, and I want to cut right to the chase. Before I even open my mouth at anything I'm reading in here, is that what I think's going on is it's a fake out type of deflation. We're going to get hammered with some serious inflation, I think, coming up fairly soon. I think it's going to be in this year, 2012. But, obviously it's not going to happen in the next few weeks. Things don't turn around that fast. This article goes on. It's talking about the Chinese and their strategy. It talks about, with the quote from the Chinese news media back in April 28th, 2009. The U.S. and Europe have always suppressed the rising price of gold. They intend to weaken gold's function as an international reserve currency because it's in competition with the U.S. dollar and the euro. And they suppress the price of gold is very beneficial for the U.S. in maintaining the U.S. dollar's role as international reserve currency. So Chinese believe that by building its gold reserves, which they're doing it not only through the government, but they're doing it by encouraging people to buy gold. Now, I don't know what the heck's going on in the United States. I know the average person in the United States is not buying gold or silver. Definitely not. It's not being encouraged, and I know in certain sectors you'd almost think a lot of people are buying gold and silver, but the average person definitely is not doing it. It says the Chinese are buying more, building up their gold reserves because it not only will safeguard itself against the declining value of the dollar, but encourage central banks around the world to expand the gold purchases as well. And large gold reserves being held in China as they build them up is also beneficial in promoting the internationalization of the renminbi, Chinese currency. So obviously that's a dream of all countries. Even the Russians want their ruble to be the international reserve currency. Although you can quite say that's impossible right now. You never know what's going to happen in the long-term future, though. In the decade between 1999 and 2009, central banks dominated by the West were net sellers of gold in every single year. That's up to 2009. They're no longer. That's not like the case anymore. They're net buyers, which tells you something. And that's despite the fact that the gold in that time soared from $250 an ounce to $1,200 an ounce, 400% gain. Well, more than a 400% gain. Actually, it's almost a 500% gain. But anyway, I don't know how to say 400% gain there. But anyway, they also talk about Gordon Brown, about selling off gold from the UK when it was down super low. And there was an angle to that was also in the time when the euro was being pushed, and it was helped to push the euro get started. I mean, they're not mentioning that in here, but that was really a lot behind why Gordon Brown sold a good portion of the UK's gold at such a low price at that time. They're not mentioned in here, but that's a fact. U.S. policy makers are just worried about preserving the dollar's role as a main currency reserve. They're also worried about the higher price of gold could have effect on a nation's debt burden. And that's another angle that nobody really thinks about. It goes on to say that the minutes of this meeting there are some comments by a U.S. delegate identified only as Fisher, but they think it's Peter R. Fisher, head of the Open Market Operations and Foreign Exchange Trading for the New York Federal Reserve. Fisher, in the minutes, made the case that rising gold prices would increase U.S. debt. Now, that's an interesting angle I never heard of. Fisher explained that U.S. gold belongs to the Treasury. However, the Treasury has issued gold certificates to the Federal Reserve banks And so gold also appears on the Federal Reserve balance sheet. If they were to be a revaluation of gold, their certificates would also have to be revalued upwards. I guess they don't keep them at cost basis or whatever. However, to prevent the Fed's balance sheet from expanding, this would lead to sales of government securities. So the net benefit to Treasury would need to be carefully calculated. Since sales of government securities would expand the public portfolio of government securities and also expand the Treasury's debt servicing burden, the interest they got to pay on the debt. So if the price of gold goes up, they'd have to revalue these gold certificates up. That means they'd have to sell more treasuries and they'd have to pay more interest on more debt. I guess when they have a gold certificate being held as an asset, they don't have it held as at cost, that they'd have to increase the value of it. But now the tide is turning. The dollar and the euro are in the ropes, and emerging markets have been steadily increasing their gold purchases. I don't know, it doesn't look like the dollar's on the ropes, but obviously with the debt ceiling being raised all the time, and the debt clock now at probably $15.2 trillion, I assume the dollar is on the ropes. I mean, that's not a bad assumption to make. While authorities in developed countries are making it more difficult for investors to build gold holdings, China and other developing markets are doing just the opposite. They're actually encouraging the population to adopt physical gold or also to buy in exchange traded funds. Now, maybe they're, I know I don't like these ETFs at all either, but in China, I'd imagine if they had a scenario like MF Global happen, the guy would have already been, if he was still alive by the authorities, he'd been already arrested in jail, and that would have been the end of it. That's one reason that I would think that the Chinese probably would be able to do some electronic investments more so than in the Western nations, because it seems in the Western nations people get away with things too much, which encourages more people to do more of the same. There's one thing I was looking at, and this was a chart I picked up. I see these numbers about the money supply, and I get all kinds of different numbers. I saw that one about from Mises Institute. That number doesn't show anything like this chart, and maybe this is different numbers, so I don't know what's going on exactly, but both charts do show a lot of the money supply going up. But this chart is showing that the money supply since 2009 has increased 217%. Actually more than that. So, but what I'm looking at is we're looking at a slowdown in the economy. There's less production going on, but the money supply is more than doubled. You would think the prices would have doubled, but the prices have not doubled. Actually, the prices are staying about the same. Sometimes they're retreating. What's going on? People are hoarding money. That's what's going on. This is an article about QE to stave off the euro deflation from December 22nd, right? There is conflicting views between the leaders in the EU financial community that what to do in the European Union. Some are saying that there's some deflation risk starting to emerge, and they're calling for some types of quantitative easing. Now, Germany is big time against any kind of quantitative easing because of what happened in their country back in the 20s in the Weimar Republic when they had super high inflation. So there you have an historical reason to go against it, and they're actually doing fine where they are right now. Their numbers look very good in that country. The comments made by Lorenzo Smaghi, ECB, European Central Bank Executive Board member, he made a strong indication that the central bank would expand its policy tools to possibly prevent possible disastrous economic slumps in continental Europe. He says he hints at what he was saying though, he's thinking that there's going to be possibly some deflation risk, and he's saying that it might do some type of quantitative easing. I think they will, and the reason I'm saying it is I'm partly agreeing with just what Mark Farber says and Jim Rogers, two people I trust. And you know what? If there's absolutely no way out of a situation, what are you going to do? You're going to do quantitative easing, right? I mean, that's the way I look at it. They're not going to let this thing collapse. The powers that be want the euro to continue, so they're going to do something, and it'll probably be quantitative easing. But and maybe in the long term, euro is going to collapse. But like I kept saying, I don't think it's going to collapse right away. You know, you might see it go back up to 140 again or something like that to the dollar, whereas it's like 128 to the dollar right now. So I don't think, and this is talking about Mario Draghi. He's talking about he doesn't want to do. He's not talking about any quantitative easing. He's saying we won't achieve anything with quantitative easing. The first thing he wants to do, his first priority, is to restore trust in Europe, and he doesn't want to do that by doing any quantitative easing because it'll destroy the credibility of ECB. So, but again, you can refer from his statement that do you think the euro is going to crash in the coming weeks? Doubtful. You probably hear a lot of people tell you it will, but it's very doubtful. Is it going to crash in the coming months? No. These people are not stupid. I mean, they're not going to let it crash that fast. Now, as far as it having like a worse valuation against the U.S. dollar, that may be the case. But like I said all along, the next thing that's probably going to come up is maybe a surprise devaluation by somebody else other than Standard & Poor's. Maybe Moody's might devalue the U.S. debt at some point. And when that happens, I mean, you're not going to know in advance. It's just going to be all of a sudden one day they're going to say they're going to come out with something, and you're going to see the dollar tumble, and you're going to see gold and silver go way the heck up. That's what's going to happen. So I think all the currencies are in a losing battle with the metals, even though you're seeing some pullbacks right now. And I think that is because of that fake out deflation that's going on right now. It's not real deflation. It's people. You see the charts, and this is another chart. You know, and you know what? I don't know what numbers that people dig out are accurate, but every one of these charts is telling me basically the same thing. They're pumping way more money into the system, yet the money is not flowing around the system. It's being held. And that's really basically all you got to know. What that means is that's like building up a big dam before the floodgates open up. He's talking about this Mr. Smaggy stressed. He's from the European Central Bank. On one of the board members stressed that the importance of the central bankers acting decisively. He did not rule out the European Central Bank stepping up its intervention in Eurozone government bond markets, perhaps by announcing a limit for yields or making, the yield for other bonds be closer to what the German yields are, that type of thing. So, they're probably going to they're definitely going to keep the interest rates super low. That's another thing, if they could possibly can. I know in the case of the Italy and stuff like that, they can't, but in case of Germany, they'll keep the rates very low. But it all depends on what's going on in the bond market, and I think that they probably are not making the sales they want to do because the Chinese are becoming extremely reluctant about buying European bonds. They want more concessions and all this type of stuff. So what's going on is there is a slowdown going on, very much so globally, and they're probably going to continue to print more money to counteract it. And like I said, it's that fake out deflation that's coming on. Another thing, you're talking about a third factor that was sparking higher inflation levels, which was going on recently before, was since the mortgage and housing crisis has created a big surge in demand for rental properties, house rents have been rising. So that's one area you're seeing some inflation at versus deflation. And I think that's going to be this area, and food is going to be the two areas that you're going to see a lot of inflation in. And it kind of goes back to what Lindsey Williams was saying, because what's going on is the Federal Reserve is buying up all the houses, right? The next round of quantitative easing is going to be buying up a lot of mortgage-backed securities and stuff like that. And that's going to basically be exactly what he said. I mean, if the elite are going to be owning most of the real property in the United States, and they're going to be renting it back to you at rising costs. So that kind of looks like what's starting to go on right now. This is a question mark about hyperinflation threat, and I think this is what we're going into. I don't care what all these people. I keep reading these articles about, the gold and silver people saying that, gold is still good to hold in deflation. I think this is temporary. I mean, I don't know how much longer it's going to go on. It's going to go on for no years. The super hard inflation is going to hit this year. I don't know when it's going to hit in the next few weeks. But as soon as Bernanke opens up his mouth about, another quantitative easing, it's going to start hitting. And it's just got to have to be, actually, if there's a conflict in the Middle East, that's when you start seeing some money flowing around the United States, because there is going to be more spending for defense. And that's where you might also see a trigger in the downgrade of the debt, because if they have to go over their budget caps, Moody's will downgrade them right off the bat. So you might see two things at once: war and a downgrade of the debt. So what's going to happen to gold and silver? It's going up. I'm telling you right now, it's going up. And I think that's what's going to happen. So some market research watchers, however, have highlighted concerns about inflation or even hyperinflation in the wake of the U.S. Fed's massive stimulant programs, which QE1, QE2, and it says the result will be high inflation down the road once the U.S. economy rebounds. And I'm thinking a rebound might come about due to a war. Now, that's usually kind of how it works. In fact, part of the current slow growth problem is that banks are not lending. That's what I'm talking about. They got the cash, they're not lending, and there simply isn't demand for borrowing right now. The companies don't want it, are just like waiting and watching. So businesses are hesitant to borrow with all the current economic uncertainty swirling around. So the additional liquidity from the Fed simply isn't rolling around in the financial system. There's no velocity of money. It's being pent up. I just wish I knew when this hyperinflation was going to kick in. I don't think it's going to be waiting for some extreme amount of time, though. As long as banks hold excessive reserves and are not extending credit, inflation is not a concern. It will be worrisome if banks start to lend at a strong clip, and I think that's what's going to start to happen. The worry is that if the economy reverses back and the banks snap their fingers and start lending again, there's a lot of available credit and liquidity. There is a risk that a lot of money can enter the system really quickly. That is classically how hyperinflation starts. No brainer. So the contingent on the economy turning around and growing really quickly doesn't seem likely. Where I think it might happen is the war situation. So, holding gold and silver is probably going to, whoever has that stuff is actually going to do very well, while a lot of other people are probably going to be suffering a great deal. So it's the right place to be for several reasons. But, I'm almost looking at this stuff. It's almost like clear as day to me. Although I can't pinpoint an exact time when this hyperinflation is going to kick in. But considering that Bernanke is talking about, people that watch Bernanke or experts at Bernanke, or supposed experts on Bernanke, they think QE3 is going to start in the first quarter of 2012. And considering like the inflation numbers were very low, there was no inflation in November of 2011, and there's actually decline in prices of the index on October 2011. I would think that he is going to do this, and it's not going to have an effect on prices because we've been seeing this money supply going up and up and up. This is one of the most radical charts. But people, or actually, let's put it this way: the people that run the banks, the biggest banks, the people who run the biggest companies, are not really in spending the money. It's not really getting around. And where I think it's going to start getting around is the same old game as before, the military-industrial complex. Now, the only way to really expand the money supply greater from here is add a lot more debt, and if they do that, they're going to downgrade the dollar. You're going to see Moody's do that. After Standard & Poor's did it back in August. It was August 6th, 2011. Moody's going to do it, and once they do it, it's going to cause gold to go a hell of a lot higher. And combine that with the money coming out of the floodgates and actually coming into the system. That's where you're going to see your gold and silver prices go way the heck up. I'm going to tell you right now, I think silver is going to go to at least $500 an ounce. And I think that's partly because of inflation. Now, I don't know about this thousands of dollars an ounce stuff. I mean, we'd have to get into some serious inflation, and I totally disagree with people who think silver's going to be worth way over $1,000 an ounce with no inflation. I think that's impossible. There's a lot more silver out there than people are aware of, and they will get it out of the ground at much lower prices than that and satisfy demand. But as far as it going up to $500 an ounce or more, I don't consider that unreasonable at all. And I'm definitely going to be holding out a good part of it for at least that much. That's what I'm doing.